Keep that in.
Up until this point, you'll notice we've left out the other popular stock exchange in New York, the NASDAQ. It came about in 1971, and it was built on a premise of a pretty simple idea. What if you didn't need a physical trading floor to trade stocks? Instead of specialists congregating at posts and auctioneers reading off names, it was just a screen with two columns. People willing to buy at one price, people willing to sell at another. They built a linked network of brokerage houses worldwide with everyone seeing the same prices at the same time. And now it started with smaller, faster growing tech companies that the NYSE wasn't particularly interested in. Apple listed there in 1980, so did Microsoft and later Intel. The companies that would eventually become the most valuable on earth started on the exchange that the establishment did not take seriously.
One man's trash is another man's apple.
The 1990s were something else entirely. Other than my birth, the internet arrived, and with it came the reasonable observation that it was going to change everything, followed by the slightly less reasonable conclusion that every company with a .com in its name was therefore worth billions and billions of dollars, regardless of whether it made any money. Between 1995 and 2000, the NASDAQ rose 400%. Companies were going public with no revenue, burning cash at speeds that would make CFOs physically ill, and getting rewarded for it. Pets.com raised $82.5 million in an IPO in February 2000 and was out of business by November of the same year.
9 months from IPO to gone, that's gotta be some kind of speedrun record.
The sock puppet they used in their Super Bowl ad cost more to produce than some of their quarterly revenues.
Come on!
Webvan raised $375 million, that is a lot of money, to deliver groceries and managed to lose money on every single order while simultaneously building out a billion-dollar warehouse infrastructure. The market was reflecting information about the world, but it was a mirror held up to a collective hallucination that we were all in on. The NASDAQ peaked in March of 2000 at 5,048. By October 2002, it had fallen, oh my goodness, 78%. It would not recover to that peak for 15 years. Then 2008. How we got there was different, but the pattern was pretty similar. We had an asset class that was financialized beyond any connection to its underlying value. Credit made it easy to participate with money people didn't have. And when the assumptions broke, the cascade was absolutely catastrophic. 1928 was both crying and laughing. As you saw in the movie The Big Short, housing prices were packaged into mortgage-backed securities. Those securities had been rated AAA by agencies with catastrophic conflicts of interest, and the whole structure was built on the premise that American housing prices could not fall, both nationally and simultaneously.
Hell is a basement, I guess, and that basement is part of a house with an adjustable mortgage rate.
Lehman, which has 25,000 employees, will be liquidated.
Lehman Brothers filed for bankruptcy on September 15, 2008. It was the largest bankruptcy filing in U.S. history. The Dow lost more than 50% from peak to trough. The federal government intervened at a scale never seen since the Roosevelt era, backstopping banks, buying assets, and cutting rates to essentially zero, where they would remain for years. Both crashes had the same underlying problem. The information the market was generating had become detached from reality. In 1999, the market was telling you Pets.com was a serious business. In 2007, it was telling you a mortgage-backed security full of subprime loans was as safe as a treasury bond. We learned, once again, that the exchange is only as good as the information flowing through it. And when the incentives are structured to produce bad info, the market prices that in and calls it a day.
This is the fifth time we've seen this movie. And you sit on the edge of your seat and you yell at whichever character it is, don't go into that woodshed. But they keep going in.
The exchange doesn't have any opinions, it's just a scoreboard, baby.
Cue the Pusha T again.
Put numbers on the boards.
For most of the market's history, participating in it required friction. You needed a broker, you needed a phone call, you needed a minimum account balance that excluded roughly everyone who wasn't already doing well financially. The commissions alone, $40, $50, sometimes more per trade, meant that casual investing wasn't really a thing. The market was open to the public in theory, but it was expensive and very exclusionary in practice.
That's a distinction that matters a lot when you're tracking who is able to build wealth over time.
I actually felt this firsthand. During my first ever internship in 2010, I tried to day trade shares of WebMD with $500 in my brokerage account. She too lost on fees trying to day trade WebMD. I was selling at higher prices than I was buying at. The bad news was the commissions were more than $8 per trade. While I made a bit of money on the gross trades, I lost an aggregate on the net due to fees. Also, doing research on the WebMD stock convinced me I had cancer and a serious case of lupus.
I went in researching a sneeze and I came out with a will.
Robinhood launched in 2013 with zero commission trades and a smartphone interface that made buying a share of Apple feel like ordering a burrito on DoorDash, sans the Dasher fees.
How to buy stocks while serving up a new look.
By 2021, it had 22 million funded accounts. The critics, and there were many, pointed out that gamifying investing for people with zero investing experience during a period of zero interest rates and stimmy checks going out there, maybe not a pure public service. Looking back, both things were true. Democratizing access to markets is good. Wrapping that access in confetti animations and GIFs every time you execute a trade is a different combo. The GameStop episode in January of 2021 was the manifestation of that tension. A community of retail investors on Reddit coordinated to buy shares and options in a heavily shorted stock, forced a short squeeze that cost institutional hedge funds billions of dollars, and briefly made a company that sells physical video games and strip malls the most talked about financial story in the world. Melvin Capital, a hedge fund, lost 53% in a single month. The little guys beat the big guys using the same information infrastructure the big guys built. A true David and Goliath story. Then Robinhood halted trading in GameStop at the worst possible moment for retail investors, and everyone remembered who actually owns the pipes.
Hey, if it weren't for Vlad, I'd be a GameStop millionaire.
Crypto arrived with a bigger promise. What if you didn't need the pipes at all? The blockchain is a distributed, immutable ledger. Wow, those are hard words. A record of transactions that nobody controls and everybody can verify, which in theory removes the need for the centralized exchange entirely. No NYSE, no NASDAQ, no clearinghouse, no counterparty risk, baked into every transaction by virtue of the fact that you're trusting an institution to be there tomorrow. Bitcoin launched in 2009, 1 year after Lehman's demise, which is either a coincidence or the most on-brand origin story in financial history.
Yeah, it makes you wonder if Satoshi worked at Lehman and then found himself with just a little bit of extra time on his hands.
What crypto actually delivered was more complicated. While the technology worked, the ecosystem around it reproduced every pathology of traditional finance at roughly 10 times the speed. Insider trading, fraud, leverage, spectacular blow-ups, a class of early participants who got extraordinarily rich while retail investors bought in at the top, and also the Hawk Tuah girl had a coin.
My Hawk meme coin is live!
FTX collapsed in 2022 with $8 billion in customer funds missing and its founder tweeting from his underwear in the Bahamas. The Venetian lenders of the 14th century would have recognized the basic shape of it immediately, and Shylock would have gotten his pound of flesh rather than sending SBF to Rikers. Today we have the clarity to see that there's limited utility in many of these coins, and they are even less a store of value than we thought.
Mom, how did we get so rich? Oh, honey, your dad was an early investor in Fartcoin.
Prediction markets are the latest iteration of the same underlying question the Amsterdam Stock Exchange was asking in 1602. Can you build a mechanism that aggregates dispersed information and turns it into a price? Polymarket and Kalshi let you bet on the outcomes of elections, economic data, and world events. The prices they generate have, in several high-profile cases, actually been better predictors than polls, expert forecasts, or traditional media coverage. They've never gotten a Fed interest rate movement wrong. SaaS and AI spend is heating up, and most finance and procurement teams are already searching for shade. Uber burned through its entire 2026 AI budget in 4 months. ServiceNow did the exact same thing. Your vendors are counting on you to sweat through your next renewal and pay more than you should. Cool down your SaaS and AI spend this summer with SpendHound. Through June 12th, qualifying companies that sign up get $500 just for getting started. Teams using SpendHound reduce software and AI spend by up to 30%, using real pricing benchmarks from over 1,200 companies across 10,000 AI and SaaS vendors. So when your next renewal hits, you're not taking the heat. You know exactly what fair pricing looks like and what you should negotiate for. SpendHound also includes on-demand procurement experts who build negotiation strategies, review contracts, and ghostwrite emails on your behalf. That means you can stop getting burned by the tools you need and cut the ones that you don't, before that auto-renewal torches your budget. Rated #1 on G2 in SaaS spend management, SpendHound is free forever for teams up to 1,000 employees and only $10,000 per year for enterprise teams, with $150,000 in savings guaranteed. Don't let your vendors enjoy your summer budget more than you do. Sign up by June 12th and get $500. How's that for a hot deal? Go to spendhound.com/CJ. That's spendhound.com/CJ.